Greetings traders and welcome back to another In-Depth with Chris episode. In today's discussion, we will be covering what the Average Directional Index is, otherwise known as the ADX. This is an indicator that usually is around to help us get a better idea of how strong a particular trend is. So yes, that is correct. It is a technical based indicator. So if you are in the hunt for a new trading strategy or just trying to expand your trading knowledge, then sit down, buckle up, and also click that like and subscribe button down below so I can keep coming out with videos for all of you out there. And let's dive on into the Average Directional Index and see how we can potentially find some trades using it so we can better pass the Gauntlet Mini. At the core of trading, price movements aren't just a game of ups and downs. Instead, most of the time, the trader that is riding in favor of an accurately depicted trend will be the one that's coming out on top in the long run. You've heard the old adage, the trend is your friend, and the ADX is a tool that is intending to give us a better depiction of how strong that trend really is our friend. The Average Directional Index, which is known as the ADX, is a technical indicator that measures the strength of the trend. The indicator is non-directional and it's derived from two directional movement indicators known as DMIs. The indicator is plotted as you see here on the bottom of this chart. Essentially what we're seeing on the right hand side are a series of numbers, and the idea is that these numbers are going to range from 0 to 100 on the top end. And on the chart, the ADX line is accompanied by two separate directional indicators. We have the positive directional indicator, which is the plus DI, which in this case is this green line here. And then we have the negative directional indicator, which is going to be the red line here, if you didn't already figure that one out. And the ADX line is usually plotted in white. So that line that's kind of going through both of them here, that is going to represent our ADX line. The idea is that when we look at the relationship that these lines are having with each other, as well as how price action is responding in accordance, we can get an idea with how strong the particular trend that we're witnessing is. So instead of just being aware that the market is moving upwards, it further attempts to let us know how strongly the market is moving upwards. Or if the market is falling down, it tries to let us know how strongly that bear run might actually be. The Average Directional Index was developed by one of the most famous technicians of the 20th century as it pertains to trading, and that was J. Wells Wilder. In 1978, he introduced the technical trading tool for the first time in his book, New Concepts in Technical Trading Systems. Although this was more than 40 years ago, the indicator is still equally efficient today. At first, the indicator was intended to serve the needs of commodity day traders, but today it is applied across almost all markets, including stocks, ETFs, mutual funds, and futures, with no real reason as to why it shouldn't be. In fact, Wilder's work is so essential that today many of his concepts are still at the core of charting software. He is also the father of some of the most popular indicators, such as the Relative Strength Index, the Parabolic SAR, and the Average True Range. He is just a staple of the trading technical analysis indicator community. Understanding the information from the ADX is relatively simple, which is why it's favored amongst many traders. As we mentioned, the ADX is usually positioned below price. As you can see down here, we have three lines interchanging. Remember, the green line is going to be our plus directional indicator. The red line is going to be our negative directional indicator. So when the negative directional indicator, this red line over here, when this line is up high and it's above the green line, that is said to be during a bearish market. When the green line is above the red, you guessed it, it is said to be a bullish market. As you can see during these two corresponding periods here, when the ADX, the negative ADX, was above the green, we did see bearish activity, and when the green line, our plus DI, was above the negative DI, we did see bullish activity in the market. Something else to pay attention to is the ADX line itself, which is obviously this white line. That's the only line left to talk about. And depending on how high this line is on our 0 to 100 scale that is said to interpret how strong the particular trend that is currently being displayed is. So if the ADX was, say, up at 73, that would be an indication of an extremely strong trend. With this chart, we can see an example of what type of trends we're witnessing based on how strong or how high the ADX value has risen to. If we're in the 0 to 25 range, we're saying generally that this is a weak trend scenario, but it doesn't mean that there is no trend. At 25 to 50, now we are witnessing a strong trend. At 50 to 75, we're now witnessing a very strong trend, and 75 and beyond is going to be an extremely strong trend. Generally, in this case, when the market is exhibiting a 75 and beyond, you're usually witnessing very powerful directional moves, usually in a unidirectional fashion, meaning if it's going up, it's probably not pulling down too hard along the way in order to hit the 75 and beyond number. With the ADX, we can pay attention to the ADX value itself, or we can pay attention to the plus and negative DI lines and watch how they cross over each other. So there's a series of two main reads that we can gain from the ADX indicator. One comes from the value of the ADX itself, the other comes from the relationship that the plus and negative lines have in correlation to each other. Let's talk about some ways that we can use the ADX to jump into the market to justify a position or to potentially close out a position that we have already open that doesn't agree with the current read that's being presented by the ATX. The first strategy that's very common is the divergent strategy. This simply means that price is going one way and the ADX is not agreeing with the amount of momentum that is being displayed. So what that means is if price is rising as it is here and the ADX all of a sudden started getting lower, that's an indication that this bull run might be coming to an end and we can be on the lookout for the market to fall. If we were to completely reverse the scenario, it would hold true looking for the market to rise during a bearish fall off. So if the green line was below the red line, that would be an example of a bearish scenario where we're expecting a reversal to the upside because the ADX in that case would then be rising. So once again, pay attention to the location and the trajectory that the ADX line is showcasing, also in relation to which way price is going. The ADX can also help us identify rangy portions in the market. This will usually occur when the ADX line is below 25. When we're below 25, but not falling too incredibly low where we're hitting zero and we're just kind of moving perfectly sideways, generally we should be expecting price itself to be moving sideways as well. And if it didn't, that would take us back to the previous scenario where we would have some type of divergence and then we would treat it accordingly. But if we see the ADX below 25, we're still witnessing some type of a trend. However, it's not the strongest trend, and if it's somewhat maintaining, moving sideways, we should be, in theory, expecting price to continue moving sideways as well, because that's characteristic of what needs to happen in order for the ADX to look like it does down here in this box. Using the ADX to identify crossover signals is another common use that traders do use the ADX for. And in order to do this, all they're doing is paying attention to the relationship that the red line and the green line in this case are having with each other. Remember, the green line is going to be our plus DI, the red line is going to be our minus DI. So if the ADX is above 25, this is a very normal range for traders to then say there is some type of trend being shown that I'm interested in being involved with. They'll then wait for a crossover to occur and look to trade in the direction of that cross. So if the positive line is crossing above the negative line and we are above the 25 with the ADX line, this could be a good location to look for a long position. On the other hand, if it was the other way around and the red line was crossing above the green line and the ADX was also above the 25 line, we could look at that as an opportunity to go short because there is a strong bearish trend as well as the emergence of that activity based on the cross of the positive and negative line. The advantages of the ADX are quite plentiful. The fact that it's a highly precise indicator in trending markets makes it very appealing because, generally speaking, it's not too difficult to identify trending markets, at least relatively speaking. And then we have the fact that it helps find the strongest trends to trade. The ADX, being a trend indicator, will give us a strength indication of the trend, which means we can stay on the side of only strong trending trades. Also, it accurately quantifies the strength of the trend, which is helping us find the strength of the strongest trends. It's all quite synonymous here, but it also alerts about changes in that trend momentum, which is important because this can foreshadow those reversals in the market. Then, it can also help confirm the validity of a trend breakout. It can confirm the validity by letting us know how strong the particular move is. And it does work with a variety of instruments. The ADX is a very simple indicator with very solid reads that it's outputting that are hard to confuse, and as such, it does couple well with other indicators. As for the disadvantages, it is in fact a lagging indicator that follows price, which means it isn't going to be the best foreshadowing tool out there. Now, it's also known to be less effective during sideways moving markets, but the good news about that is the fact that it is helping identify when the market is in fact sideways so we can avoid those periods. Also, it can generate false signals if it's used on shorter time periods. And what this means is if we use the ADX on, say, a 5-minute chart, but we haven't checked, say, the 30-minute or hourly chart, we might be getting ourselves in a position where we're actually going with the very short-term trend, but against all of the higher time frame trends. And also, it can't be used as a standalone indicator, and this pretty much applies to all indicators out there. We don't want anyone to just use an indicator with no outside knowledge. Using the indicator as your only indicator is fine, but that means that you're still using it in conjunction with price action and other trading knowledge. So, in a nutshell, the ADX is a very valuable indicator because it provides simple to read information and it's relatively clean, so you can use it in conjunction with other indicators without finding too much clutter going on the screen. The concepts and the reads behind it are pretty black and white. I strongly recommend checking out the ADX indicator on your practice account before you ever consider going live with it to see how you feel about it. But if you are interested in learning more about the application in live markets, we did do a video in the past, a practical video, so to speak, of the ADX indicator, so go check that out if you understand what I'm saying. But until next time, thank you very much for joining me, folks. It's always a pleasure. Best of luck in the markets. I will see you soon.